Good morning. Today is the 9th of September, and we've had an interesting week, haven't we, Andy?
Yeah, it sure was. For a week with very little news, markets chopped around a fair amount and drifted lower in particularly notably in some of the most economically sensitive areas. The Russell was down 3.5%. The Nasdaq was the best performer for the typical reason that the top seven stocks did well, though Nvidia and Apple weighed on the market, and the S&P was down 1.5%. Bond market was, a little bit weaker across the curve. Nothing major, but weaker across the curve.
Yeah, no, for a week when everybody was back at work, we were remarkably, how shall I put it, undecided about what to do. I think a lot of people are looking at the economy and maybe beginning to get an idea that the real sector might be weakening. On the other hand, inflation is still strong. So bonds can't do much better, and that weighs on all equities. Basically what we've been saying for a long time, and that while this supply at the long end persists, and it will persist for many months, it's very difficult for real economy stocks to do much better than they are pricing in at the moment.
Yeah.
So you get this dichotomy between people wanting to be bullish and not being able to be bullish, and some others wanting to be bearish and not being able to be too bearish. So we have this tug of war going on all the time between real yields which are high, and I guess what's going to resolve it in the end is going to be what the central banks decide to eventually do.
Yeah, that seems to be right. The economic numbers, as you said, were fairly neutral. It really is going to come down to how the economy plays out, and so we are in a very much a data dependent environment. So next week we should get we never get perfect clarity on anything, but next week is the end of the data cycle before the next FOMC meeting. And, when you look at next week and say, how's it gone since the last meeting? By and large, the economy has stayed pretty stable. Like, there isn't a big roll off in the economy and there isn't a big inflationary drop or burst. It's been chugging along.
Yeah, next week we've got more supply. We got threes, tens, and thirties, which is going to weigh on the bond market, obviously, because they're issuing a lot. And then on Wednesday we have the CPI, which, as you said, is the last data point that the Fed will look at before they decide what they're going to do the week after. And really, as you said, the economy is just chugging along. I would have thought it's favored that they do a skip, a hawkish skip, so they can say, we're not doing anything now, but if something more is needed, we will not hesitate. And
Yeah,
that's going to keep things very much where they are. And, the bond market is stuck. And as such, the only things that can move and that I've noticed this week are moving are the real economy sectors. XLI had a terrible week. Uh, Even things like, which should be strong, like ETA, which is the ETF which follows the defense sector, McDonnell Douglas and all the Raytheon, Boeing, very weak. And that tells me that people are really undecided about which way the Fed will jump and how the market will respond to whatever the Fed eventually does.
right. And we'll go into more detail on the FOMC. It's an important report, sorry, an important data point in the week after next. I think the issue that we need to deal with in this week is that is there a CPI number that would and PPI number that would change the Fed's behavior? And I think the area where the Fed has flexibility is in whether they hike one more time or not. And right now, it looks very clear they're going to skip this meeting. But they may hike one more time. That's what's expected. Um, Now, that could change to we're done, or maybe it could change to something more severe than, not just one hike priced in, but more than one hike. I think that's unlikely too. I think we're capped at one hike more, unless the CPI number is just blazing hot and then is followed up by future data being hot. So you're stuck with 0 or 1 hikes. And then, as I mentioned, we'll talk about this next week with the dot plot, which the Fed then projects out what its future path is likely to be. It seems like right now they're penciled in 100 basis points of cuts in 2024. A hot CPI, maybe that goes to less cuts, and a cold CPI, maybe that goes to the same amount or maybe slightly more cuts. But that seems to be the place where the Fed is going to pay attention to this number. Do you think the equity market or the long-term bond market will do much on the CPI?
As you said, depends on the number, but it's more likely that they panic because of the supply if the number is hot. A hot number would really destroy the long end because we have the auction the same day, and I don't think anybody will be very pleased to buy bonds, long bonds, yielding, whatever, 420, 430. They would much rather back up the whole curve and then they'd be happy. But you are definitely getting signs of yield curve steepening. People are much more comfortable buying the short end rather than the long end, simply because we get this feeling that all the central banks, and let's not forget the ECB next week as well, which is an important data point, would like to be done because they are beginning to see certain signs, more in Europe than in the US for sure, that the real economy is beginning to feel the hikes that have already taken place. Naturally, they all happen with a lag, so there's a lot of tightening still in the pipeline for the real economy, but it does seem like the real economy is beginning to weaken slightly. We're not seeing it yet in the unemployment numbers. We could see it in retail sales, which is another data point next week. So the market is definitely getting the sense that the central banks would like to be done if data allows them to be done. The question is, would CPI, i.e., inflation, allow them to be done? Because the real
Right.
danger here is that they all turn skippy, in inverted commas, and that is just not enough to bring inflation down to where they want it, i.e., their target of 2%.
Right. I think
Now,
it's very
what it
clear
could
that they,
mean
sorry.
what it could mean is that they silently, not publicly, they would never state this, they silently abandon the 2% firm target where they want inflation to be, if not in 2024, then certainly in 2025. And they tolerated 2.5, 2.7, 2.8, and allowed the tightening they already have done to bring it down to 2% over a longer time period, which I guess the equity market would like, but certainly the bond market I don't think would like.
Right.
So you get this dichotomy of the pull from the bond market and the push from the equity market. And that is why equities have been outperforming bonds, because bonds are much more sensitive to any kind of explicit or implicit abandoning of the very firm 2% target, especially with all the supply that they have in place.
Yeah. Yep. Agreed with that. So it sounds like to me we're heading in the same direction we've been heading in, which is a weakening real economy, inflation, which has been coming down, but is structurally fairly high and significantly above target, but coming down. And that's been our macro outlook. And we're now at the same time saying the Fed and the global central banks, for that matter, are in pause mode by and large. And so now we'll have to see how that all plays out. But I don't think our macro outlook has changed much.
No, we have absolutely no reason to change our macro outlook at the moment. Uh, we have so many data points coming up that those will naturally influence it. And as far as the portfolio is concerned, we have so much cash, we have optionality. We don't need to do anything this week. We can wait for all these data points and then decide whether to jump in.
Yeah. So we'll send an email after CPI if there's any change to our portfolio. We remain very defensive, minimal equities, relatively small bond positions, gold and commodities. I guess the question is, what it sounds like to me is that markets are on a somewhat of a tipping point in which we've been chopping around for 3 to 4 months with and since August, a downward bias, but no trend. And so, we talked a little bit about it with many people about how to run a good portfolio of beta, which is what our goal is for you to be well positioned in beta, but also take opportunities in, rebalancing and going to cash and so on. One of the other investment options that we have not yet considered, and we'd like you to begin considering, is investing in trend following type investments that are market neutral by mandate, but get on trends when they start to trend. What do you think about that idea, Nick?
Yes, it's something that the time is coming for that. I'm not sure that this is the precise moment. Trend following CTAs and hedge funds, market neutral, is something that has been marking time, i.e., their performance has been absolutely flat for a year.
Like cash.
They've done, yes, because we haven't really had a trend. But I hope that our subscribers are getting a sense that we feel that we are getting towards a point where a real trend can develop. And as such, it's time to begin thinking about investing some of the cash that we have to some of those strategies because it gives us even more optionality. We would basically be giving up the interest that we get, the 5%, 5.25% on cash, which is coming up to a maximum, right? Because none of us expect that we will be picking up 6%, 7% in something like whatever it is, USFR or on deposit, on a cash sweep. So we know that we're getting towards a maximum there. And when that happens, then trends start to develop because people start abandoning cash and going into other instruments. And I'm getting the feeling, and so are you, obviously, that we are getting towards that point. We might not be perfectly there. We might be still a quarter too early, but it's time to start thinking about investing in those strategies.
Right. And the important thing for the beta investor is that we're long only. So the only trends we can take advantage of are going long or an asset. By using a trend following strategy as part of your beta portfolio, you can actually get exposure to trends that are unfavorable, that are negative. One of the alternatives, obviously, is since what we're saying is we don't know which trends will develop. It could be a recessionary trend where stocks underperform bonds. It could be a inflation like Nick described, where inflation is allowed to run hot for a lot longer. That would be bad for bonds and good for stocks. It's unclear which of those trends will develop, but it's fairly clear a trend is coming. And so for a long only portfolio, we simply can't do that. We can't short anything. So one of the ways to do that is to buy straddles on assets. meaning we could buy a call and a put on stocks and a call and a put on bonds. But your timing has to be perfect when you do such a thing, because you pay, not only do you use cash, but you actually pay away cash that deteriorates very quickly if nothing happens. These types of funds that we're discussing don't do that. They just stay in cash like instruments until they get a trend and then they move. So I guess the basic point is we'll be coming back to you with some ideas on how to allocate a small part of our portfolio to these forms of trend following assets, and think that it's not always a great time to have these types of assets in your portfolio, but it looks like it's becoming a time to have them. So we lost Nick there. He'll be back with there isn't any portfolio, but he'll be back with his review of the portfolio later. We'll talk to you via email if there's anything notable on the CPI, and we'd like you to start thinking about these ideas of market neutral trades.
The portfolio remains unchanged. Obviously, since we did nothing, we're at about 18% in equities and 28% in bonds, but quite heavy really towards TIP. So we are inflation protected. Nothing else has naturally changed. I've updated everything, including the broker statements, which are in here. All you need to do is click and they will appear. And I've also updated the chart pack. So you can see really that on the week, the real economy was very weak indeed. Things like ETA, things like XLI, and certainly EWW and IDO, and a lot of foreign markets are beginning to get really hit. And what we will talk about in the next few episodes is how to take advantage of some trend following systems like CTA as an ETF, but I will have many more of them in here in the chart pack so you can follow them yourself and evaluate them, but we will talk about them a lot more. No order entry this week, but what you will get for sure is an email on Wednesday and Thursday saying what we think the results of the CPI and of the ECB actions are, and how they will impact assets and what we will do as a result. Thank you very much indeed, and have a wonderful weekend.